They don't want you to know this, but the real danger to America's economy isn't inflation, politics, or even the stock market. It's the ticking clock on $9 trillion worth of U.S. debt coming due within the next year, and the silence surrounding it is deafening. Every few decades, the world's largest economy hits a breaking point. In 1929, it was debt-driven euphoria. In 2008, toxic mortgages. Now, in 2026, it could be the nation's own bills, a massive rollover of Treasury debt that must be refinanced at rates triple what they were just a few years ago. Think about that. Trillions, borrowed at 1%, will soon be reissued at 4 or 5%. No conspiracy, it's math. And math, unlike politics, doesn't negotiate. According to official U.S. Treasury data, over $9 trillion of marketable debt will mature between 2025 and 2026. That's nearly half of America's entire publicly held debt. Every dollar must be rolled over, meaning the government will have to borrow new money just to pay back the old. Now, a few years ago, this was cheap. In 2020, the Treasury was paying barely 1% on many notes. Today, 10-year yields hover around 4.3%. Short-term bills push 5%. That gap isn't just a headline, it's a budget breaker. The Congressional Budget Office now projects that by 2026, interest on the national debt will consume more than 3% of America's GDP, more than defense spending, and rising faster than Social Security. We are borrowing to pay interest on our borrowing. That's the definition of a debt trap. And the trap springs when rates stay high and the refinancing bill arrives. History doesn't repeat, but it rhymes. Every major financial crisis has shared a single pattern: cheap credit, followed by expensive consequences. In the 1970s, Washington borrowed heavily while inflation raged. When rates jumped, the economy stalled into stagflation. In 1994, a sudden bond market sell-off wiped out billions and crushed emerging markets. In 2008, households rolled their debt at teaser rates until those rates reset and the system imploded. Now the borrower isn't you or me, it's the United States itself. And unlike a family mortgage, America can't refinance quietly. Every auction, every bond, every yield is public and watched by the entire world. Markets right now look calm. Stocks hover near record highs. Consumer spending still hums. But beneath that calm, foreign investors have been pulling back. Japan, once the largest holder of U.S. Treasuries, has been selling to defend its own currency. China has reduced its holdings by hundreds of billions. Who fills the gap? Domestic banks, money market funds, and the Federal Reserve itself. But banks are already sitting on over $500 billion in unrealized bond losses. If yields rise again, those losses widen, pressuring balance sheets and tightening credit. That's how a liquidity event starts, slowly at first, then all at once. Here's what most people miss. A Treasury refinancing wave isn't just about government debt. It sets the price for every other form of money on Earth. When the U.S. borrows trillions at higher rates, it drains global liquidity. Corporate bonds reprice, mortgage rates rise, currencies shake. It's a domino chain that can end in a credit crunch, exactly what triggered 2008. But this time, the scale is larger, because the borrower is the issuer of the world's reserve currency. If confidence in U.S. debt weakens even slightly, the ripple effects won't stop at Wall Street. They'll circle the globe. While mainstream news focuses on inflation, cooling, or AI stocks soaring, hedge funds and institutional investors are quietly repositioning. Gold ETF flows are rising. Cash balances in money market funds hit record levels over $6 trillion. Even Warren Buffett, the ultimate long-term optimist, is holding more than $150 billion in cash, his highest ever. Ask yourself why. They see what's coming: the rollover of cheap debt into expensive debt, and the pressure that will put on every asset valued at yesterday's rates. Every crisis begins with a simple question: can they pay? When that question gets louder than the assurance markets shake, for decades, the U.S. Treasury was the risk-free asset. But in 2023, Fitch downgraded America's credit rating from AAA to AA+. Their reason? Erosion of fiscal discipline and rising debt burdens. That was before this $9 trillion refinancing wall even arrived. Now, if rates stay high through 2026, the annual interest cost could top $1 trillion, a first in U.S. history. And what happens when the world's safest borrower looks like a risk? Every other market, stocks, bonds, housing, must reprice to match. Here's the paradox: every crisis is also a cleansing. When overvalued assets fall, they don't disappear, they transfer ownership. From the leveraged to the liquid, from the panicked to the prepared. That's how Rockefeller built an empire after 1907. That's how Buffett did it after 1974 and 2008, and that's how the next generation of investors will do it again if they understand what's really happening now. They say history doesn't repeat, but every time money gets cheap, greed takes the microphone, and every time it gets expensive, panic finishes the speech. We've seen this movie before. In 2000, the dot-com bubble promised a new economy. Then rates rose, liquidity dried up, and nearly 80% of Nasdaq value vanished. In 2008, real estate was too stable to fail. Then adjustable rate mortgages reset, and Wall Street's confidence collapsed overnight. Now, in 2026, the same silent mechanism sits inside the Treasury itself, except this time, it's national. For 2 years, the world has been obsessed with the Federal Reserve's every word: pause, pivot, soft landing. But the real story isn't the Fed's language, it's the government's calendar. Every month, billions in short-term Treasury bills mature. Normally, they're quietly rolled over. But as each maturity hits, the U.S. must issue new debt at today's higher rates. This process is relentless, like refinancing your mortgage every few weeks while rates keep climbing. The result? The government's interest bill compounds. In 2020, Washington spent around $345 billion on interest. By 2025, the CBO projects over $870 billion and rising. When interest costs rise faster than tax revenue, fiscal flexibility dies. That's when markets start to whisper the unthinkable question: what if the safest asset isn't so safe anymore? Money isn't gold. It isn't paper. It's confidence. The belief that tomorrow's dollar will still buy something real. When confidence cracks, empires wobble. In the 1970s, faith in the dollar collapsed after Nixon ended gold convertibility. The result? Inflation hit 14%. Oil prices quadrupled. Savers were destroyed while debtors prospered. Every modern empire has faced this moment: the British pound after World War II, the yen in the 1990s, and perhaps now the US dollar as global patience thins. America's advantage has always been that everyone needed its debt. But what happens when the buyer disappears? Foreign central banks already hold a smaller share of treasuries than at any point since 2002. Private funds are filling the gap, but at a price. Higher yields, shorter maturities, greater volatility. That's not stability, that's dependence on constant refinancing. When government debt reprices, everything else follows. Corporate loans reset. Mortgage rates stay high. Valuations that looked cheap suddenly crumble. It's not just numbers on a balance sheet, it's the pulse of the economy. The danger is duration compression, when investors refuse to lend long-term because short-term rates are already high. The Treasury then leans heavier on short maturities, exactly what's happening now. That shortens the refinancing cycle, accelerating the rollover spiral. It's a treadmill running faster each month, and 2026 is when it hits full speed. In 1994, the Fed hiked unexpectedly. Bonds crashed globally. Orange County, California, went bankrupt. In 2011, a debt ceiling standoff caused a U.S. credit downgrade and wiped 17% off the S&P in weeks. In 2022, the UK pension system imploded when gilt yields spiked, all because debt that was safe suddenly wasn't. Each time, policymakers said it was contained. Each time it wasn't. The pattern is cruelly consistent. First comes complacency, then comes liquidity stress, then comes the forced selling. And when that happens in sovereign debt, the benchmark for everything else, the shockwaves make 2008 look like rehearsal. But here's the hidden truth: every collapse is also a clearing. When overpriced assets fall, cash becomes power. In 1929, the few who held liquidity bought entire companies for cents on the dollar. In 2008, those who saw the credit cycle for what it was built, generational fortunes buying, foreclosed property, and distressed debt. The 2026 rollover crisis, if it unfolds, will do the same, punishing leverage, rewarding patience. While most panic at falling prices, smart money will hunt value in silence. Treasuries at yields unseen in a generation, quality equities sold off indiscriminately, commodities with real scarcity. That's the irony of every panic. The opportunity hides inside the fear. You can already see the rotation. Gold quietly broke record highs above $2,400 an ounce. Bitcoin, dismissed as speculation, behaves more like digital gold every cycle. Big institutions like BlackRock and Fidelity are launching spot ETF products, not for hype, but for liquidity safety. Meanwhile, corporate buybacks are slowing, and insider selling is up, classic late-cycle behavior. The market is talking, even if the media isn't, and the message is clear: the easy money era is over. The next phase will reward those who understand real value over paper profits. Ask yourself what happens when the government already running multi-trillion-dollar deficits, faces another trillion in interest costs. It can't default. It can't print without inflation. It can't cut spending without political pain. That's when policy innovation or desperation arrives. Yield curve control, debt monetization, stealth inflation, each is a different flavor of the same thing, transferring the burden from the government to the people holding the currency. That's how inflation works, a silent tax that repays debt with cheaper dollars. It's not announced, it's engineered. And that's why the debt rollover isn't just a financial event, it's a redistribution event. Wealth moves quietly from savers to borrowers, from fiat to real assets, from trust to control. Every great investor understands one rule: cycles don't end, they evolve. In crisis, the weak sell what they must, the strong buy what they want. So, when 2026 arrives and headlines scream, "Panic," remember, that's how history advertises opportunity. The data doesn't lie. $9 trillion is real. Rates are real, and the rollover isn't optional, it's mathematical inevitability. The only question is who benefits from the reset and who gets buried by it. They say every empire ends with one illusion, that it can borrow forever. But when that illusion fades, two kinds of people emerge: those who panic and those who prepare. Right now, the mainstream keeps repeating, everything's under control. But the bond market, the quiet giant beneath every economy, is whispering a different story. Yields refuse to fall. Auctions grow thinner. The cost of money refuses to go back to sleep. That's not stability. That's the sound of a system grinding against its own limits. When debt saturates the system, prices stop reflecting reality. Stocks rise not because profits grow, but because liquidity demands a home. Real estate inflates, not because wages rise, but because cheap credit floods the market. But when credit tightens, everything reprices. That's what 2026 could become: a reckoning of false valuations built on a decade of free money. Yet, in every reset, the same truth emerges. Value never disappears, it just changes hands. In 2008, panic sellers handed prime assets to buyers with patience. In 2020, fear drove markets down 35%, only for prepared investors to triple their gains a year later. And if the Treasury's $9 trillion rollover shakes confidence in 2026, the same pattern will repeat. Those who understand the mechanism will not be victims, they'll be participants in history's next wealth transfer. If you study the investors who survived and thrived through every major crash, you'll find one common rule: they stayed liquid when others were leveraged. When the crowd chased momentum, they built reserves. When fear arrived, they bought what others couldn't afford to hold. They didn't predict the day, they prepared for the moment. And that's exactly what today demands. Being prepared doesn't mean hoarding cash and hiding from markets. It means understanding which assets survive inflation, which benefit from volatility, and which collapse under debt stress. Tangible value, land, resources, productive companies survives. Leveraged speculation, meme stocks, zombie firms evaporates. Cash, used wisely, becomes a weapon, the power to buy when others beg for liquidity. That's why the next 2 years are not about fear. They're about positioning. Remember 2007? Every headline said, "Housing is strong." Remember early 2020? Economy firing on all cylinders. Every era of confidence ends with the same phrase: "This time is different." It never is, because underneath the headlines, the math always wins. Debt costs rise, revenues lag, confidence breaks, and when it does, opportunity shows up wearing panic's disguise. So when 2026 headlines scream, "Meltdown," remember, it's the moment history hands power back to those who studied the cycle instead of ignoring it. Let's make this real. If yields spike, Treasury bonds themselves could become bargains. Safest assets finally offering real return. If stocks sell off, profitable, cash-rich companies will trade at discounts unseen in decades. If inflation resurfaces, hard assets, energy, infrastructure, metals regain dominance. Every scenario of fear has a mirror of opportunity. But to seize it, you need awareness before the crowd, before the algorithms scream, "Sell." That's the purpose of understanding the debt rollover. It's not to panic you, it's to position you. Because when trillions refinance, capital doesn't vanish, it rotates. And those who follow the flow, not the fear, will define the next generation of wealth. The coming years will test the world's faith in paper promises. The U.S. will likely survive, it always has, but the system will emerge changed. Debt will be higher, money will be looser, and those who mistook liquidity for wealth will learn the hardest lesson of all. Wealth is what remains when liquidity dies. So don't ask whether the crisis is guaranteed. Ask whether you're prepared to recognize it. Because one thing is certain: cycles don't end in comfort, they end in capitulation. And that's where opportunity begins. The $9 trillion rollover isn't just a number, it's a countdown. A countdown to repricing, to revelation, to reality. So while most people scroll through headlines, you now know what they don't. The mechanism, the math, and the moment that could define 2026. The only question left is the one history always asks. When the crash comes, will you be one of the panicked or one of the prepared?